Growth or value? This is one of the greatest dilemmas in investing. But I don't really have a favorite. When the market is bullish, overvalued and everybody's buying growth, you should be clever and buy value. But this year it doesn't look so bullish, does it? Actually, what we experienced in the past 3-4 weeks is just a small correction. And I expect stronger corrections to happen this year. But exactly for this reason, the more people are going to panic sell this year, the more you should invest in growth. So today, I'm giving you 4 of the best growth ETFs I'm buying right now for 2025. ETFs that give you exposure to AI, cloud computing, and the biggest tech giants of the decade. Plus, I'll break down exactly why they are a buy, how to invest, and the risks that you need to watch out for. My name is Rick, your favorite Italian investor and twin of Manu Ginobili. And now let's dive right into the first ETF, which is my favorite growth ETF. QQQ is one of the most well-known and widely traded growth ETFs out there, and for good reason. Not only it's a great ETF, but since last February it lost over 11%, which doesn't make it a crash, but officially a correction. QQQ tracks the Nasdaq 100 index, which consists of the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. This means it's heavily weighted towards tech, consumer discretionary, and healthcare. Some of its biggest holdings include Apple, Nvidia, Microsoft, Amazon, Broadcom, Meta, Netflix, Costco, and Alphabet, which are all wonderful companies that are not going to disappear tomorrow. So, QQQ is great. We all know that. But why should you consider buying it right now? There are a few reasons. First of all, the AI boom continues. Companies like Nvidia, Microsoft, and Google are leading the AI revolution, and QQQ gives you direct exposure to all these giants. Sure, AI has been growing into a bubble in the past few years, but now slowly the bubble has turned into real earnings and the potential of AI doubles every month. Think about how incredible the introduction of ChatGPT 2 years ago was, and how right now basically every company has its own AI. The second reason for buying QQQ are the interest rates and market conditions. We all know growth stocks took a hit when interest rates went up. And now, with the Fed not cutting them since December last year, the market is waiting for something to happen. With high probability, at some point, what will happen will be a rate cut, after which QQQ will surely see a nice rally. Another reason why you should buy QQQ, and growth stocks in general, is the tech earnings growth. Despite some valuation concerns, big tech companies have continued growing their earnings. Nvidia is still dominating semiconductors, Apple keeps innovating, well okay, Apple is not really innovating much lately, and Microsoft is integrating AI into everything. As long as these companies keep making money, QQQ has room to run. One of the biggest reasons investors love QQQ, it's a performance beast. Over the last 12 months, QQQ has returned 16.45% compared to the S&P 500's 18.41%, which doesn't seem like much. But moving to the last 3 years, QQQ already wins with 49% against 42%. Over the last 5, 155% against 118. And over the last 10, 407% against 238% of the S&P 500. If you invested $10,000 in QQQ 10 years ago, it would be worth now over $50,000. The same amount in the S&P 500, closer to $30,000. Of course, past performance doesn't guarantee future results, but history shows that QQQ tends to outperform over the long term. So, how should you invest in QQQ? If you believe that tech will keep climbing and you have a lump sum, investing in it right away could work well considering the correction we experienced. Historically, the market spends more time going up than down. But if you're worried about short-term volatility, DCA, or dollar cost averaging, is a great way to reduce risk. When it comes to the role that QQQ should have in your portfolio, I suggest you only consider QQQ as a satellite position in addition to a core ETF like the S&P 500 or a world ETF. And since QQQ is tech heavy and tech is still quite expensive, consider balancing it with other ETFs like SHD, the Schwab US Dividend Equity ETF, or VIG, the Vanguard Dividend Appreciation ETF. Now before you go all in on QQQ, let's talk risks. Every investment has risks, and QQQ is no exception. Firstly, big tech is still overpriced right now. The 10% correction that we've seen so far is nothing. Second, I see regulatory risks, which are no long-term problem, but can cause trouble in the short term. Governments are starting to crack down on big tech with antitrust lawsuits and AI regulations. And the last risk that I see is a concentration risk. The top 10 stocks in QQQ make up over 50% of the whole fund. If just a few of these companies struggle, QQQ's returns could suffer. That's why it's important to have a balanced portfolio instead of going all in on just one ETF. The second ETF is probably something you didn't think about because it covers small cap companies in the growth sector. Yes, because come on, we've been snobbing small cap for over 15 years now, which made them extremely overvalued right now. And before telling you which ETF I have in mind, this is how I imagine most of you are reacting right now. You're going to check the performance of small cap, or you know it already, and you're wondering, if large caps have been performing so well over the last decade, why bother with small cap? Large caps have crushed them for over 15 years. But that's exactly why I think that now is the time to pay attention to small caps again. And while large cap giants like Apple and Microsoft have dominated in the past, history tells us that small caps tend to outperform after economic slowdowns and interest rate cuts, which is exactly what we're going to go through in the near future. So let's break down why this ETF might be one of the best plays right now. Between 1979 and 1983, the Russell 2000 outperformed the S&P 500 by 80%. And it was a period of extreme economic turbulence in the stock market. Between 1983 to 1990, during the long economic expansion of the 80s, large caps rebounded. The S&P 500 outperformed the Russell 2000 by 91%. And then, 1990 to 1994, small caps again outperformed the S&P 500 by nearly 50%. From 1994 to 1999, the S&P 500 large caps again outperformed the Russell 2000 small caps, this time by 93% over 5 years. Then a new era of turbulence came between 1999 and 2014, between the dot-com bubble burst, 9/11, Afghanistan and Iraq wars, the financial crisis in 2008, and small caps strongly outperformed large caps once again, dropping the S&P 500 by 114%. Finally, since 2014, large caps have been again outperforming small caps. So you see where I'm getting. We've had 11 years of outperformance of large cap, and if history tells us something, is that between small and large cap there is not a clear winner. They alternate periods of overperformance and underperformance. Small caps have typically outperformed large caps during period of economic turbulence. And this is exactly what you expect from the US this year. The ETF I'm presenting today is SLYG. This ETF has over $3 billion in assets under management, a low expense ratio of 0.15% or $15 per year for every $10,000 owned, and belongs to one of the biggest investing firms around. The fund has 337 holdings, earnings per share growth of 12% in the next 3 to 5 years, and is valued at 19 times earnings. So really not high price for a growth ETF. So if you want to invest in small cap, this is how you play it. First, don't go all in at once. Small caps are volatile. A dollar cost averaging method works best here, especially in uncertain markets. Next, I'd consider using SLYG alongside something like QQQ or SHG. That way, you're not just betting on one sector, you're diversifying between large cap tech and small cap growth. And one more thing. Small caps tend to do really well in tax advantage accounts like IRAs, because many of them don't pay dividends. So if you're holding for the long term, consider where you're buying this ETF. And when it comes to risk, let's be real. Small caps are riskier. These stocks have higher volatility and can see bigger price swings. They're also more sensitive to economic downturns. If 2025 doesn't go as expected and we see a recession, small caps might struggle in the short term. Alright, the third ETF is one of the strongest long-term plays in the market. VGT, the Vanguard Information Technology ETF. VGT is one of the most diverse market cap weighted tech ETFs. It gives wonderful coverage of the whole tech industry, tracking an index made up of stocks of large, mid-sized, and small US companies. Inside, you'll find companies in basically 3 areas. Companies that sell technology services like Adobe and Cisco systems, manufacturers of equipment such as phones or computers like Apple and Microsoft, and also semiconductor companies like Nvidia. Now, you might be wondering, why pick VGT over something like QQQ? Well, here's the thing. While QQQ covers a mix of tech, consumer discretionary, and some other sectors, VGT is a pure tech ETF, meaning you're getting direct exposure to the highest growth sectors of the past 2 decades. And look, nobody knows if tech is going to crash down in the next few years or just go through some corrections, but what's sure is that technology is going to become more and more a substantial part of our lives. So I don't believe tech is going anywhere. Between AI, cloud computing, semiconductors, even fintech, there is an immense potential for the future. So if you believe these trends are going to keep growing, then investing in a focused tech ETF like VGT makes a lot of sense. Of course, the Fed has frozen interest rates since December last year, but it's not going to stay like this forever. If the actions taken by the Trump administration stabilize and inflation also comes down, interest rates are expected to go down in 2025. And guess which sector benefits the most from lower rates? Tech. When borrowing costs drop, tech companies can expand faster, invest more in research and development, and drive even higher growth. But let's talk about performance now, because VGT has been an absolute monster over the years. In the last 10 years, VGT returned 473%, turning a $10,000 investment 10 years ago into almost $60,000 today. The S&P 500 instead, represented by VO here, returned 221% in the same time period. And lastly, in the last 12 months, VGT returned 7.42% and the S&P 500 9.84%, which can be a good sign because it means that the price of tech had actually corrected a little bit more. Nevertheless, I'm going to say it again now because I want everybody to know that I don't believe that the corrections are over yet. This year, I believe it's not going to be a good year for the stock market, but it's totally okay because these are the times where we can actually make a lot of money buying stuff at a cheap price. So be happy if your portfolio loses 20, 30%. Alright, be happy is kind of a stretch, but be happy for what will come next. So let's get now to strategy. VGT is a long-term play. This isn't something you trade in and out of. You buy it and you hold it for at least 5 to 10 years, possibly forever. And one additional strategy I'd consider is buying on dips. Tech tends to be volatile, so whenever you see a pullback of 10-15%, that's a great time to add to your positions. Also, if you already own QQQ, adding VGT can actually be a smart move, since it increases your exposure to pure tech while reducing weight in non-tech sectors. Alright, we've covered tech, small cap, and the Nasdaq 100. But what if you want a more balanced approach to growth investing? Something that gives you exposure to high growth companies, but with broader diversification. That's where SCHG comes in. SCHG, or the Schwab US Large Cap Growth ETF, is one of my favorite growth ETFs and gives you exposure to the top growth companies in the US while keeping costs ultra low. If you want to get a picture of SCHG, SCHG is like a hybrid between QQQ and VGT, but with a twist. It tracks the Dow Jones US Large Cap Growth Index, which means you're getting exposure to a wider set of growth stocks instead of just tech. And by the way, it's also one of the cheapest large cap growth ETFs, with an expense ratio of just 0.04%, significantly lower than QQQ's 0.20%. Compared to QQQ, SCHG has more exposure to sectors like healthcare and consumer discretionary, making it a bit more diversified, and has been one of the best performing ETFs in the last decade. 10 years return has been 303% against 377% of QQQ. 5 years return has been higher than QQQ with 198% against 189%, and even in the last 12 months, SCHG showed stronger performance with 10% against 8.5% of QQQ. Alright everyone, let me know in the comment section below which growth ETFs are your favorite. And be nice and drop a beautiful like to this video and subscribe to the channel for more videos like this. I wish you a great day or evening, and as always, I'll see you in the next video. Ciao!